everyone, I'm Jasmine. So today I'll be doing a brief introduction on what we're presenting today. So basically, our report looks at two major parts of trading. So the first one is our go-to market making case and a series of option strategies. So we basically wanted to see how coding, logic, and strategy work together to really improve the trading outcomes. So in the first section, we refined a VBA market making algorithm to boost liquidity and profit. And in the second part, we built and analyzed different option structures using payoff diagrams. So overall, this report really shows how smart automation and strategy can really turn theory into real trading performance. All right, so in this section, I'll walk you through how I developed and improved my market making algorithm for the RIT simulation. So basically, the whole purpose of this algorithm is to act as a liquid provider, so continuously placing buy and sell orders and earning profit from the bid and ask spread, and as well as managing inventory risk. So in version one, the algorithm lost $414, but after analyzing its weaknesses and redesigning the logic as well as the coding, version 2 was able to achieve a profit of $937.50. So this improvement wasn't really luck, so it came from better coding structure, less manual input, and dynamic adaptation to market movements. So in the first version, the algorithm simply placed one buy and sell order around the last traded price. So this created three problems. So the first one is that it being a fixed spread. So it never adjusts to volatility or price shifts. And the second is manual confirmation. So basically, pop ups interrupted execution and this slowed down the reaction time. And the third is no automatic refresh. So orders often stayed outdated as the market moved. And as a result, it frequently bought above and sold below fair value, leading to poor trade quality. And although it was able to execute 170 orders, the average buy price was $19.90, and the average sell price was $19.89, so producing a total loss of $414. So to fix this, I completely basically restructured the whole logic in version 2. So I switched to mid-market quoting, so bids and asks were always centered around the current prices instead of it being fixed. I used global variables and a countdown order function to really ensure that two active quotes at all times. And I was also able to add auto cancel and refresh the logic so the algorithm could instantly replace the outdated orders, and included a trading window check to really stop delayed session exposure. So these changes made the algorithm faster, smarter, and more adaptive, and it executed only 8 high quality trades, buying at $19.60 and selling at $20.03. So this was able to generate a profit of $937.50. So basically, ultimately, version 2 met all of the four market making goals. So it was able to provide liquidity, capture the spread, control the risk, and reacted dynamically to market changes. So by transforming the code from static to adaptive, so this was able to continuously quote, managing risk, and be able to generate consistent profit. All right, so now I'll talk about why the changes work. So these improvements directly strengthened all key four objectives of making. So the first one is liquidity provision. So the algorithm maintained two active quotes at all time, ensuring that it's always present in the market and available for others to trade. The second one is profit maximization. So by being able to quote around the mid-market price, it consistently captured the spread instead of chasing prices or reacting too late. The third one is risk management. So built-in auto cancel logic and position limits stopped overexposure. So this helps the portfolio stay balanced and controlled. And the third one is dynamic reaction. So the continuous refresh system allowed the algorithm to instantly adjust to changing market conditions, so tightening the spreads in stable periods and widening them when volatility spiked. So in short, version 1 was static, manual, and inefficient, but version 2 became dynamic, automated, and consistently profitable. So just this transformation shows how small, targeted coding adjustments such as mid-price quoting and automated order refresh can lead to huge improvement in performance. So ultimately, these changes made the algorithm behave like a true professional market maker, constantly adapting, efficiently providing liquidity, and generating steady profits.
Thank you, Jess, for reporting. And we'll be processing to discussion one. In market making, the big ask price determines how a trader earns profit by buying slightly below and selling slightly above market value. In our simulation, we found that a steady spread as used in version 1 was ineffective because it stayed fixed around the last rate and slowly react to volatility changes, leading to a loss of $414. Version 2 introduced a dynamic spread. centered on a mid-market price and refresh automatically. And this alone could to tighten during stable periods and widen during volatile movement, leading to a profit of $930. Ultimately, a dynamic spread mirror professional market maker behavior, balancing liquidity provision with control risks. Discussion 2. A good market maker must go continuously but still control inventory risks. In version 2, automation replaced the manual delay from version 1. The algorithm kept exposure at above and below 25K share, could skew code to naturally rebalance position, and use auto recoding to reflect still order around the mid price. It also reduced order size when exposure grew and flattened all the position at section ends. These symbols keep the book balanced and letting the algorithm still liquid without taking directional bets. Discussion 3. Market making strategies generally struggle in trending markets because they rely on mean reversion, expecting prices to move back toward the mid price. When the price keeps rising or falling, one side of the could hit repeatedly, building inventory in the wrong direction. Version 1 fixed spread suffered this often buying high or selling low, while version 2 mid-price logic helped limit that exposure. The critical point is that in strong trend, liquidity provider fix adverse selection, informed trader take the better side, leaving the market maker holding the loss. Discussion 4. When we apply the market making strategies across highly correlated assets, we multiply instead of diversify. A single price shock can ripple through related securities, causing simultaneous losses across the entire portfolio. To manage this, traders must monitor aggregate exposure, widen spread when correlation rise, or hedge between linked instruments. Without this control, what looked like diversification actually become a hidden leverage. Discussion 5. Rebates fundamentally reshape market-making incentive. Instead of paying commissions, exchange reward liquidity providers for each limit order fill, even on tight spread. This transformed market making from chasing price trend to earning steady micro profit through queue priority and efficient order placement. By rewarding patient and depth, rebates align private profit with public market stability, encouraging traders to supply liquidity rather than amplify volatility.
So in the part, we looked at four option trading strategy: the long corner, long string, long straddle, and the long butterfly. Each of the option strategy has a different risk and return profile depending on how volatile the market is. The main idea isn't about predicting the market direction, but about using changes in volatility and time decay to generate profit. The long corner strategy was structured by buying one put with strike 46, selling one put with strike 48, selling one call with strike 50, and buying one call with strike 51. This created a four-leg strategy to profits when the underlying asset remain within a narrow price range, specifically under the inner side from 48 to 50. The theoretical payoff shape shown in the option strategy show a flat, profitable in the middle range and limited losses in the outside. The realized gain of $1,950 matches the theoretical payoff prediction. We have shown that profit underneath the volatility condition. The result reflects a proper timing and price execution. The long butterfly was constructed by buying one lower call at 47, selling one middle put at 50, and buying one high call at 53. This project is designed to achieve maximum profit when the underlying price is closed near the middle price of 50. Unlimited losses if it deviates significantly up or down. The payoff shape is sharply peaked, showing narrow profit range around the center. The PR performances show that it had a loss of $2,490, already accounting for option premium. Although the butterfly recorded a loss, its real-life PL and payoff shape matches with the theoretical expectation. The negative return reflects that market price had drifted away from equilibrium rather than an execution error.
The long strangle strategy, it combines two out-of-the-money options, a long 48 put and a long 53 call, designed to profit from large price swings in either direction. Theoretically, its payoff is V-shaped. showing unlimited upside and limited downside but to the premiums paid. In the risk simulation, the realized P&L was for 17 minutes, confirming that the underlying price stayed between the two strikes. This means both options expire worthless, exactly as the model predicts under low volatility. Compliance and trading records confirm correct execution with no fines. Overall, while the strategy incurred a small loss, it accurately reflected the behavior of a long strangle, limited loss in calm markets with high potential only if volatility increases sharply. Next, long straddle. It combines a 49 put and 49 call, both at the same strike, to profit from large price swings in either direction. Its payoff is V-shaped, giving a limited upside and limited loss equal to the premiums paid. And in the simulation, the realized P&L was 3520 minutes, showing that the underlying stayed near the strike. So both options lost value as expected under low volatility. Compliance and trading limits were met with no fines. Overall, this strategy performed exactly as theory predicts. It only becomes profitable when volatility rises sharply or prices move decisively away from the strike. Overall, our results matched theory really well. The counter worked best in a calm, neutral market, while the strangle lost because volatility stayed too low. Santa Clara and Sarento remind us that in real markets, things like margin calls and costs can reduce returns compared to ideal models. And as Smith and Trick explained, it's all about balancing flexibility and commitment. The counters give steady gains while the straddle and strangle only shine when markets move sharply. So overall, our results confirm both theory and real-world trading behavior.
So this will be the conclusion for our presentations. First of all, it will be the ideal case to end with automation drives performance. In order to shifting from manual intervention to a fully automated market-making algorithm, improves speed, consistency, and profitability. We prove that logic-based automation outperforms human timing in dynamic markets. And about OP2, volatility determines option success, in which payoff results show that strategy performance depends more on volatility conditions than price directions. Counter and butterfly excel in stable markets, while straddle and strangle works best in volatility was high. So that was the end of our presentation. Thank you.